Welcome to my discussion on deferred taxes. This pencast is going to be an introduction to the concept of deferred taxes. My overreaching goal in this pencast is to help explain to you why we use deferred tax assets and liabilities to help us calculate an accurate current tax expense. We've spent many semesters learning about how to calculate pre-tax accounting income on the income statement. And in these discussions, we always learned how to use generally accepted accounting principles. We recognized revenue when it was earned, not when the cash was received or not received, and to recognize expenses to match them against revenues. The Internal Revenue Service doesn't have any such goals when they calculate taxable income. They're usually trying to affect fiscal policy, and they use Internal Revenue Code rules when they calculate taxable income. And then they have you file in a form called an 1120 where you show your current income tax expense. Given that we're using a different set of rules, it's no surprise then that accounting income could very well be different than taxable income. In my example, I'm saying our accounting income before taxes is $10,000, but when we compute our taxable income, it comes out to be $7,000. As you can see, there's a $3,000 difference. In this example, I'm saying the $10,000 is my pre-tax accounting income, and the $3,000 comes about from an installment sale. In this installment sale, I record the revenue in my income statement because I have earned it according to the revenue recognition principle, but on my tax return, I do not record the revenue because I haven't collected it yet. Your tax return's much closer to a cash basis than generally accepted accounting principles are. Let's assume a really simple example now. Let's assume we're in a 40% tax bracket. That our taxable income will be taxed at 40%. And so our taxes on the tax return, 40% of $7,000 will be $2,800. So we know what taxes payable are. 40% of our installment sale would be $3,000 times 40%. That would be $1,200. And in this case, since we don't have any changing tax rates or NOL carry backs or forwards, we could just take your accounting income of the $10,000 times that by 40% too, though that won't always be the case, and say, well, our accounting income would be $4,000. Let's put these three numbers together and see what they do for a tax expense entry. When we calculate entries to recognize current tax expense, we're going to have a tax expense number that will be shown on our financial statements up on our pre-tax account, taken against our pre-tax accounting income. We're going to have a taxes payable number that is driven directly by our tax return, and then we're going to have differences, in our case an installment sale. That installment sale will be recognized in the future, and I will owe taxes on it. Since I've already recognized it in my accounting income and set up a receivable on my financial statements, it's only appropriate that I recognize the tax consequence. So we'll set up an account called the Deferred Tax Liability, meaning something I owe in the future as a result of the past. And the taxes payable, driven from the tax return, $2,800. The deferred tax liability, driven by the amount that will be picked up in future years, $1,200. And the two of those together would equal our tax expense. In our very simple example, it also equals what we calculated, but that won't always hold true. That's a very simple example of why we need a current deferred tax liability to be recorded when we pick up our taxes payable to make our tax expense correct. Think of that effect on the balance sheet. On our balance sheet, of course, we're a corporation, we have taxes. We have that installment receivable. And installment receivables on our books for $3,000. And we have a tax liability, a deferred tax liability, I'm going to abbreviate that is the direct tax consequence of having that installment on our books. So we have the revenue of $3,000, and we also have a tax liability that goes along with that. And those taken together made our tax expense on our income statement correct. Fascinating, isn't it? There's a few things I want you to note as we move forward to remember from this discussion. The first thing is that deferred tax liability can also be called a future taxable item, because that $3,000 will be taxed in the future. The $3,000 on our balance sheet shows the revenue. The $1,200 is the tax consequence of that revenue. The second thing that you should note is that a difference that creates a deferred tax liability can come about from recognizing revenue, which leads to an asset on our books with a different tax basis and financial basis. In this case, our installment receivable. And it can also come from recognizing an expense. Take the example of prepaids. On prepaids, when we set up a prepaid, we take something to an asset account instead of an expense account because we haven't consumed it yet. So if we prepay supplies, we set them up on our balance sheet as an asset. When we use them, we'll take them off and expense them. On our tax return, we get to take them immediately, so they would cause a decrease from pre-tax accounting income to taxable income, much like our installment sale. So you can have deferred tax liabilities come from revenue items or expense items, but one thing is telling is they always create an asset when they originate. Another thing to remember is this is called the asset liability approach, recognition of income taxes. First, you calculate what your taxes payable will be, which we did. Then you calculate what your deferred tax liability or asset will be, which we did, and the sum of those two will equal your tax expense. In this case, it happened to tie exactly to 40%, but that won't always be the case. The last thing I want you to note is that any time that you're going to record a deferred tax asset or liability, it must be temporary in nature. And what I mean by that is, although it's not being recognized currently on your tax return, it will reverse out and be recognized in future periods. The year that it happens is the year of origination, and then it washes out later on when that installment sale, in our example, is finally collected. I guess I really have one more thing to say about these. When a difference originates, it can come into existence, as in our case, the $3,000. It can grow bigger, it can shrink, and it can go away. It can do all of those things. But once it's determined, it's a deferred tax liability. It's always a deferred tax liability. It comes into existence as one, it grows as one, it shrinks as one. A deferred tax asset, a deferred tax liability will never turn into a deferred tax asset. I know it probably sounded like a really weird thing to say, but keep that in mind. Once a liability, always a liability.